for President Gualtieri, who is coming. I'll just say some words as a Secretary General of the European University Institute about this initiative. This initiative takes place in the framework of a series called EUE in Brussels, because the European University Institute, which exists since the 70s, is an important element of the European policy in the field of higher education and also culture. And so we believe that it is important to make people aware of the many contacts we have with the European institutions, namely the European Parliament and the European Commission. I would like to thank the European Commission Director General Marco Buti, who is a great friend of the European University Institute, but also Maria Kayamanidou as a representative of DG Research, for their support. This is also an opportunity for us to organize something together with the alumni, because the majority of our alumni, which is an important community, is in Brussels, and so this is why we deem useful to co-organize with them this event. This event is in fact the presentation of a project called ADEMU, a Dynamic Economic and Monetary Union, financed by Horizon 2020 program, and where important intellectual energies of the European University Institute were devoted. The project had a steering committee led by Professor Ramon Marimon, who will be the main speaker tonight, but also with the participation of main teachers and researchers of our institute. And it is a pleasure for me to see among us tonight two former head of departments of our institute, Professor Harpat Habram and Professor Giorgio Monti, who were respectively head of the Department of Economy and Law in our institute. So I hope that Professor Marimon will demonstrate not by words, but by facts, the excellence of our scientific contribution to the European Union reflections. Thank you.
Thank you, Mr. Ambassador. Ladies and gentlemen, it is an honor for me and also a deep satisfaction to be together with you today to the ADEMU event, which is a very successful project on an important component of the economic and monetary policy of the European Union, the component on the fiscal and monetary framework. ADEMU is financed from one of the very first call for proposals of the socioeconomic and humanities challenge of Horizon 2020, which seeks to address the aftermath of the economic, financial, and social crisis stemming from the 2008 shock. In the 2014-2015 cycle of socioeconomic and humanities challenge, several sets of calls seek to address a variety of problems that the European Union faced, like slow growth, unemployment, notably for young unemployment, labor markets, social crisis, or migration. This because the socioeconomic and humanities challenge of Horizon 2020 promotes research and innovation in domains of policy importance for the European Union and support the use of project results by policymakers and policy implementing authorities. The ultimate objective for socioeconomic and humanities research is to contribute to the design of evidence-based policies useful for the European societies. ADEMU project expresses explicitly the need to provide better theoretical foundations when redesigning the institutional architecture of economic and monetary policy. ADEMU puts its works in the European Union institutional context and modifies the economic concepts accordingly. This is not done very often in the academic research. This is why ADEMU research is in a position of developing concrete and operational reform proposals for the European Union economic and monetary policy instruments, such as the European Stability Fund for EMU or an unemployment insurance system for the euro area. In the next programming period of the European Union, starting from 1st of January 2021, the framework program for research and innovation, the so-called 9th framework program, will, I hope so, have a strong socioeconomic and humanities component, and this should be promoted and strengthened. We would like to continue on the present commitment and policy orientation of the socioeconomic and humanities component. We will need the full support of political authorities of the European Union, in particular that of the European Parliament, and ADEMU project will be a strong ambassador for economic research in this particular context. Thank you very much for attending the event, and thank you for your attention.
Thank you. Thank you very much, Secretary General Vincenzo Grassi and Maria Kayamanidou, for your kind words and to being here, and Marco Buti for also being here, and all of you. We are heading towards the Easter break, so it's very appreciated in a day like this to be here. And I also, personally, I had been in a previous life in this Parliament, but then as a Secretary of State of Science and Technology, and I always thought that scientists, they also have to give account of their work. So I think that's we are here for. As it's been explained, it was started almost 3 years ago. We end now at the end of May, a demo project. So this is a consortium, and it's coordinated by European University Institute, but also Cambridge, University of Bonn, Toulouse School of Economics, University College London, the Catholic University of Portugal, and the Barcelona Graduate School of Economics. So strong economics component, but we also have our group of lawyers. Here is one of our colleagues in the UI. In the aftermath of the euro crisis, has been a clear understanding that we need to strengthen the resilience of the euro area. And that's, I'm going to talk about two main projects. We have done a lot of research, mostly understanding more lessons from the crisis and how the whole euro area has been working. But today we'll concentrate on two projects. One is about unemployment insurance, and the other is about the European Stability Fund. So that's the first one. And some of my co-authors are here. This is joint work with Arpa Tabran, Joa Nogueira, and Lucas Meyer, which are here, and they're welcome also to reply questions. And the issue is an issue that you are very aware, is the discussion of whether we should have an European unemployment insurance system. This goes back to the 1975 Marzolini report, but this is an issue that has now appeared again with force because we understand that in periods of crisis or recessions as we had, it's very difficult to satisfy these needs and at the same time keep the constraints on the budgets that we need. And so that's why this is part of the discussion. And therefore, we also understand that there's possibilities of risk sharing, given that the countries, we are not exactly in the same situation. So we understand that there are also other social gains from integrating more the labor markets, but we want to concentrate more specifically on what the gains can be on having an employment insurance system. So we ask several questions, and we understand that the difference is about the labor market. So the first question is that whether what are the benefits before that. As we all understand, there are very clear differences on unemployment levels, and not only the markets, and we'll see. So the first question we ask is, what are the benefits for developing an European unemployment insurance system? This is an issue that people typically have very clear positions. Either it's yes, or either it's no, it's a bad idea because it's already been done at the national level, and it will be too many transfers from low unemployment countries to high unemployment countries. So we want to face these questions, but in particular, we also want to see whether there is room for improvement on the current systems of unemployment insurance, and in particular then, if there is an agreement, a possible agreement, on having among participating countries of the euro area or the European Union, on having a common, at least a common base unemployment insurance system. So as we'll see, the answers to these questions depend on how we do the design. And therefore, what we did is to step back and to study more carefully what happens, in which sense labor markets are different. And they are, in many dimensions, but it has a lot to do that in different countries, it's not just we have different levels of unemployment, but what is behind. And what is behind is how jobs get destructed, or how jobs are created, how differences in remunerations and so on, many different things. But we want to understand it in a way that we can put it one next to each other and to run what we call counterfactual experiments. We put them in the computer. So we will do this in a situation that we'll look at very carefully. These economies that we put in the computer look like the economies in the sense that we have agents that make decisions whether to work or not to work, how much to save or not to save. And they will, of course, react to different changes of policies. And we have governments that they have to finance unemployment benefits with a tax on wages. And they have to balance the budgets. So these features we see, we want to put it in a way that we can then understand what is the effects. So here is simple examples of how European labor markets look different. So what is this graph showing is, on the x-axis is like the funding rates of jobs if you are not active, and simply so you are inactive. And on the other axis, on the y-axis, whether if you are unemployed. So typically you are more likely to get an offer if you are unemployed searching. That's why it's about 45-degree lines. But countries differ in this dimension, as they differ in another dimension which is very important. Now we have on the x-axis how the capacity to get these offers, to find a job. But in the other is the possibility that you will lose the job. Okay, so here is, you can see that in countries, in some countries like Germany, it was difficult. So that's what I was mentioning now. So here we have on the y-axis the separation from a job. So you can see in the case, for example, of Spain. Spain is, or Portugal, cases there is a huge amount of destruction. And that's what we've seen in the crisis all the time. And we see here, for example, that Germany, that was difficult to get jobs, relatively speaking, but you don't lose the job. So it's very stable in a different way. So that's what makes us understand the differences, and then we want to understand how then the first reaction that one has in looking at this is these countries are way too different to agree to anything. So let's move on. Also, the policies in place are different. So all the policies, unemployment insurance, they have two features. One is what is the replacement ratio set, is what fraction of your wage, maybe from some period or something, you get when you are unemployed, called the replacement rate. And the other is for how long you can get unemployment insurance as long as you are working, as long as you are searching. Okay? So this maybe. And the countries differ a lot on this dimension. So typically replacement rates are more than 20% of the wage, but then on durations are very different. So that's maximum duration. So that's what we get from different policies. So we do first a very simple experiment, which is about something that's been proposed, even now by the IMF, to have an insurance for only extreme cases. Really bad shocks, they call it asymmetric. So the country goes through big bad shock, asymmetric, when the rest of the union is more or less stable. So can we just provide an insurance on this? So then the experiment will be simply is to just submit the country to that type of shock, and then we will look at it in two scenarios. One is that you have to do it on your own, as it is now pretty much. So what does it mean? It means that you're going to have more unemployment benefits to pay, and if you have a strict budget, here you'll have to pay the raise in the taxes. So the taxes will fluctuate on that in accordance. And the second scenario is where you have this European unemployment insurance, that they will cover you for this really bad event. So we do this simply, that's a case, let's have an example, in this case will be France, having something will be like unemployment will increase by more than 2% of what it was, and this is how you will see what happens with the unemployment, and then we just move on, and then we see what will happen with the taxes. If they were on their own, the taxes will have to be increased, the labor tax, while they could be just simply stable if they had this insurance. So we look at this, and then we see, okay, what are the gains? And we are able to compare the gains in terms of how much consumption they will benefit, in a sense, and this is along their lives. So they're very tiny, but there are some gains. There are gains for France, but most of the gains are actually for the employed. That's something counterintuitive, but it's the fact that now what we are having is much more stable tax rates, as opposed to having what unemployment benefits, in this case, they were receiving them. It's true that in some crises, even that gets not satisfied. And we can do the same exercise for, let's say here we do it for 10 countries of the area, and going through this shock, going how to this increase in unemployment, and also going how taxes change. And here we can see that the countries are different already, because, for example, Spain on the top pink is a much higher level of unemployment at the steady state, and then it has this shock. Again, if they had the insurance, they have the taxes will be constant, and that's when translates into welfare. Again, all the countries benefit, not much, relatively little, but again, it's the employee, the people working, that benefit relatively the more. So that's the first lesson we get. And it's a way that we have a framework that can evaluate and assess the different proposals which are there. This one is a proposal made in different forms. But then we go on, and then we find something which, for us, was a discovery, an interesting finding, which because we thought, well, if all the countries differ about their employment insurance policy, but they all have this feature of a replacement and duration, now we have these economies that look like the economies out there, in the sense that the flows from unemployment to employment in activity are the same. So they match, they look pretty much the same, but they're inside the computer. So we can say what these economies separately would like to have. If you ask them, what do you want to have in terms of duration on replacement? And we, as I said, we were suspicious because they were very different. But our surprise is that the answer is fairly same, pretty much the same in all the countries. And I said, it's like having the systems they are now. What they would like to have is long duration of eligibility, and maybe a lower, for most countries, replacement, between 10 and 25%. So then we say, well, that immediately suggests that maybe there's room for an agreement. Because even if they are very different, there may be an agreement on having something in common of that sort. So we just say, well, let's have a 15% replacement and unlimited duration. And then if we do this, And if we want to really have it very homogeneous, we can just have even the same tax for everyone, the tax rate. So let's try to do this first. And here are the results. What happens, some countries in green, like Spain, Italy, or the Netherlands, they really gain. This is the column that says total. This is benefits in consumption, relative. Those, and then the last one is they get a transfer. So those countries that they really like it, but also they're getting the transfers. There are countries that they don't like it because they are paying also, like Austria and France. But then you have quite a few, like Belgium, Germany, or Finland, that they are given transfers, but actually they like it. So it's not the one, say, because the typical argument is to say, well, there will be the transfers, that's bad. Therefore, well, here we show that it's not that obvious. There are countries that even if they give transfers, they will prefer the change. But of course, that will never be approved because we want everyone to be interested in getting in. We want to be in a voluntary. So then we follow the last thing we'll do here. We had done many other things, but today I will just report on this, which is, can we just have them all agree and in a way that there are no transfers? So what we're going to do is the same 15% replacement, the same unlimited duration, but now every country will pay a different tax rate, will have a different tax rate to be sure that they cover their employment insurance in the long term. So they will be insured, they will be the same tax rates, but then we'll have that, of course, for example, Spain will have a higher tax than another country. So we do this, and that's the result. Then, again, all the countries gain, and that's why we did it carefully, to be sure we get, so that's the green in the middle. And this of the order is 10 times more, at least, than what we had before. And then you can see that the tax rates are different. In many countries are actually lower. For example, in Spain it's lower than it was before. And that's something that will be an agreement. But we think of this as a floor. I mean, of course, if a country says, well, we want to have more, 20 or 30%, they can also do it. But at least it will be in an euro area or in countries that would like to participate, that everyone knows that at least that's provided. All right? So how can we do that? So the question is, how can we do that? Well, one way is to simply say, well, if they may agree, different countries to implement that reform with their own unemployment insurance systems. The only problem is that they might need to have some capacity to borrow if they have bad times. So the other is then to have a combination with the current unemployment insurance systems, but also having a fund at the European level of the countries that participate that will give this insurance when there are severe fluctuations up and down from what will be the normal quote unquote, of different countries. Of course, by doing this, then you would just provide this type of insurance. And as I said, it can also be that some country wants to have a slightly different, but we'll have at least a minimum for everyone. The fact that here we have these different taxes, it's also a good representative of in which sense a country has a better or worse, put it this way, market institutions. Because it gives exactly the idea that this experience rate in taxes it gives it this precise number. You say, look at, if Spain is paying more, it's because we have to cover this. So you have an incentive for countries also to reform their market institutions. Beyond all that, I think that's something that goes back to the original report. I think this idea is that at least this will have the labor markets more integrated. And as I said, that also can help mobility across European countries, because you know that in a situation of unemployment, you don't have to be exactly into your region or the state to have this minimum coverage. So that's something that we put on the table. But then we also look at another aspect, which is related, but is more of the whole framework of stability of the euro area, or the European Union, which is what I wanted to refer to another project, that this is about an European Stability Fund. And this is, again, with Alberto who is here, and the other co-authors, one is in China and the other in the States, so they are not here. And here, something that been major concern during the crisis and after the crisis is that something that we need more resilience is particularly in having more stabilization. Not just price stability, but economic, macroeconomic stability, which also is related to having more risk sharing. We had a huge divide within the euro area, between the stressed countries and other countries, and that's something we have to get more resilience for. So there are four things which are related. One is this aspect. The other is how to deal with severe crisis as we had, and hopefully we don't have another one, but that is how we'll take care of this. A third one is how you resolve debt crisis. Like now we still have a huge amounts of debt out there. And there is a lot of discussion about the need to have so-called safe asset, to have better liquidity in the system. And there have been proposals. The European Commission has made already proposals in December about the stabilization function and risk sharing. We'll hear more about it, or about transforming the ESM into European Monetary Fund. So we'll let the Commission speak on that. What we had done, and from the beginning, is just we concentrate on this aspect of risk sharing and stabilization policies. And actually here also we find out something interesting. We were not expecting that way so much, is that if you take care properly of the first, that helps you in all the other topics that I mentioned, on how to deal with crisis, on how to resolve the problems of that crisis now, and also possibly to create a safe asset. So how can we do that? Well, again, we step back. And we take the view that we can think of the European Union as a long-term relationship, or partnership, or self-enforcing. Of course, it's not a federal state, but this has consequences. For example, debt contracts, the way they're used normally, if you are in a long-term relationship, you can do better than that. Debt contracts, the way we have them usually, is more for anonymous relationships. So we want to build up on that. And how we build is, and this fund, the idea is just to have a contract, that's a central figure that, that this will have, which is a long-term contract between a member state and the fund. And it will be based on a risk assessment. The way that we were doing a risk assessment of the labor markets, it can also be done about the possibility of having more of a crisis or not, and so on, in different countries. We'll have the feature of being a state contingent, meaning that you have contingencies. You will take into account that sometimes the country is doing better than others, or also what happens with public expenditures. So it will take account of several aspects. And it will have this very counter-cyclical feature, which means that in good times you're supposed to save more, and in bad times it will give you insurance. So that's the thing that we want. So that gives quite a lot of capacity to a country or region, whoever participates, into borrow and lend and have exploited the good opportunities that may come out. But there is another difference which what we have nowadays usually done, which is we are not asking for ex-ante conditions of eligibility to these contracts. There will be conditions, but will be conditions ex post, afterwards. Depending on the performance, then, of course, you will get more or not, because that's a part of the contract. But it's like to say, if you can think of an insurance company, it's not that they say, well, I'm sorry, you're not very healthy. We don't give you anything. Sometimes they do that, but we don't want that. So we like to be able to give an answer, a possible answer, that it then is a voluntary basis, everyone will participate. And that idea is this long-term contract is not just for times of crisis, final crisis, but it will be more of a normal activity that will happen. And that builds trust. It's like if we were to design a health system, it's not very good to have only an intensive care unit. You want people to prevent, to not to have to go there before. So have a good system for that. So then what we need is we need to take into account of what we call different constraints. What does it mean? Well, first of all, as I said, this is not a federal state. So you have to count that we are all sovereign. And therefore, yes, everyone has to be possible to exit, even at some cost, maybe not as costly as Brexit. But it's not that we want this to happen. We want to design it in a way to avoid it. The best way to avoid it is to take it into account. The other is, as we said, this is about resharing, not about redistribution. So, and there should not be more redistribution than the one is wanted. Not only ex ante, but also ex post, meaning you don't want to be in a situation that the fund is losing, for example. So we'll be very strict. No one, it will never happen that the fund will be in a position of being on the lose side in any of these countries. And yet, they will give quite a lot of rewards to participants. The other is, we always talk about, well, people, the problem is that they don't do the reforms they should be doing. And that's partly sometimes what is in the MOUs. Here, we will just take into account that it will be in their advantage to do the reforms. Because if you have a better performance, for example, in respect to government liabilities and expenditures, that will be also reflected on how this contract behaves and responds. And there are two more things that we think is important. One is to account that countries are different. If one goes back to the President's report, they always talk, from the first one to the fourth, about the need of shock absorbing, because that's something we don't have. Federal states, they do have it through the budget of federal state. We don't have that. But then they say, well, we'll do this later on, when the countries have converged. I think we don't want to wait. We should be able to do it now. Now, meaning countries are different, but also countries are different in their liabilities. The amount of outstanding debts are very different. So you want to design it that will be consistent with this scenario. And the latter is that it should also be that basically self-funded, the fund. So we want to keep all this in mind when we design it, and we do it theoretically and quantitatively. We put it in the computer too. And it's just simply to find the optimal solution to this problem. It's not trivial, but we can do it. That will take into account all these constraints. And when you solve that, then you just can compare to a very simple exercise, which is, let's compare what happened in an economy that looks like the ones we had, that they use debt, sovereign debt, and to smooth. And of course, this debt, this possibility of default, of partial default, as we had it in 2012. And then, of course, that's costly. It may happen even that for a while they cannot go back to the financial markets, but eventually they might. So that's one economy. And will be, it's like having a country which is relatively impatient and would like to borrow, and then in this situation. Compared to the same country going through this, having this fund, this contract. So which countries want to test that? Well, very simple. So we're going to do that, and as I explained before, if they have this contract, they will have this capacity to do these counter-cyclical features, and they will not be transfers. And they will have incentives to apply the right policies. So what we did is very simple, is just to put it into the European countries. And which kind of features we expect to see, and then we'll see them. Well, that now will be, consumption will be much smoother, because that's a part of the stability that you can. The policies will be countercyclical. We will not see spreads as we see it now. Actually, we see them, they are negative and very small. Why? Because we had eliminated a lot of risk by pushing these contracts. And what else? You'll see the high capacity to absorb severe shocks and also existing debts. And as I said, there will be this conditionality exposed. There will be no eligibility conditions to entry. So we do this with the 5 stress countries of the euro area. And what is our risk assessment? Well, very simply, we look at what happened in those countries from 1980 to 2015. That gives us the risk profile, the likelihood that things go up and down in terms of output, in terms of government expenditures, and so on. And the data is the data of these countries that we get about debt to GDP ratio, spreads, and so on. The second column is what we have in the computer to this very similar economy that uses sovereign debt. And the third column is having the fund. Having the fund, it tells you immediately you can have higher levels of debt, yes, much more sustainable. You don't have spreads, actually you have a little negatives. And if we go on, we can, not to spend all time on everything, but we also have a very interesting features about how countercyclical the policy can be. Can we just move? So here we have, like in the first row, this says basically the consumption is much more smooth. That's what we expected. But if we go down and we see here the row PS, this is primary surplus respect to the output. If it's negative, it means that the primary surplus, it goes exactly procyclical. Okay, so it's not what it's supposed to be, countercyclical policy. See if it's negative. So what is extremely countercyclical is having the fund. So having the fund has the feature that in good times, okay, at that time you will be saving, and in bad times you will be receiving. So that's the kind of things we want, and then we can just, well, we don't want to spend a lot of time, but if you can just simply say, how does it look like? Well, let's put it, run these economies. We do in the computer, we have thousands of these things. My colleagues have done incredible work on this in both projects. So here you see on the left upper is the shocks to technology in black and the high, and then on the government expenditures, these small variations on the bottom. And these shaded lines correspond to times where it has been, or there had been default. There is no default, of course, in the fund, which is in red now. And when looks carefully, you will see the consumption will be much more smooth. In particular, if we go, what happens on the asset side, what we'll see is that they will have much higher capacity to borrow, and this is in the negative in red. It just means they are borrowing more. Why? Because in the other economy, they will have these defaults, and they will have much limited markets that will be much more strict. It's not that they're doing worse policies, because they will do in the effort to have the right policies the same or exactly before, better. And we don't see the spreads. You see the spreads in blue in the right, left, bottom corner of the other economy, and in red you don't see anything, very stable prices. That's exactly what we have, a much safer economy. So we can do something even further, which is that putting the economy into a very serious crisis. So if you put the economy into a very serious crisis, what we're going to see is something like this. So here we're going to have is there had been very bad productivity, very high expenditures compared to what it was normally. That's in the upper left. And you'll see that the output has decreased and then recovers slowly. But you have to look at it a little more carefully. You immediately see that the consumption in blue doesn't fall as much. And actually employment falls because you don't want to work so hard when you have really bad productivity. So what does it mean here? What it means is that if you look at these particular countries in terms of the assets, so you see in the, again, the shocks, and then in the upper right, you have a huge amount of credit received in this country. That's why the primary surplus is so negative, and then you have to pay it. Why? Because you had a really bad event in your life, but you had been with us. You have this contract, so you are really well insured against that. You have to pay it, but this gives you a lot of insurance. While if you were with debt, the markets, they won't give you much room to do that. So that's the difference, and that difference, again, is reflected in the spreads and so on. So that's why these kind of contracts are particularly good in times of crisis. But something that gives them that strength is precisely that we have put both things together, not just the crisis, but also the most risk-sharing on more normal times. So we can look at what are the welfare gains, and they are substantial. Much, much larger than you usually have in this kind of exercise when we do in our economics work. So this, what is here we see, this goes from really bad shocks in blue at the top to better shocks in red. Meaning what? Meaning is what will happen if you start this contract in a bad state or in a good state? Well, you'll really have much more gains, but on average, you'll have very high gains. And what did the last two columns say? What the last two columns say, what will be the capacity if you are in a bad shock to get more funding from that? Very little. What is the capacity you have is almost 100% of your GDP. Not that you want to use the whole thing, but this says that you are in a very different environment. So that's what we have been working on this. And this is, as you see, that replies to what I said at the beginning, is that we designed something for risk-sharing and stability in normal times, but it's particularly good for times of crisis. So that, back to the health example, is that if you have this system that you have both things, the intensive care unit within an hospital that does normal treatments, that's a much better design. And of course, as it showed, it has high capacity to absorb debts, which is a problem that we have now. So, and in this country, so there is going to say, well, we can have a new contract. Not just because you have a big crisis. Maybe now we don't have a big crisis, the economies are growing, but maybe now is a good time to part of the debt of this, put it in that form. And what it means put it in that form is that this fund is transforming risky debt, sovereign debt, which is unconditional, to conditional, because it is conditional on how the country is doing ex post, but is safe. So what it means is that the fund in the balance sheet, they have something which is safe. That's why we don't have these spreads. So that changes substantially. How can you do that? Well, we can have like a light version, which is simply based on the ESM, the European Stability Mechanism, using the contracts they have now, making them more contingent, exposed. And maybe two new ones have these features. Having the conditionality more exposed than ex ante. Or just, for example, provide this possibility to countries that we think through the semester and so on, that they need to do something. Here say, well, maybe it's part of the liabilities that should be taken care of in that format. Or we can just go the full version, which is just simply to have this as a full risk-sharing capacity or stabilization and so on. So then is when it will have more this effect of being a safe asset in the euro area. And once you have a fund of that form, then it might accommodate to other things as a backstop for the banking union, for the single resolution mechanism, or for the type of fund I was planning before for unemployment insurance. And eventually, but that's eventually, they might be able to even to just trade this into the market as a safe bond that will pay back by their assets. As I said, we have this concern and this lesson from the crisis. We also learned from the crisis that institutions, in this case, the ECB had played a major role. People might discuss about performance or something, but I think there's a consensus that, for example, when Draghi pledged in 2012, that had an effect. There's other work being done about the ESM within the ADEMU project. This is by Giancarlo Corsetti, Aitor Erce, and Timothy Ui, that they study how the ESM has been doing with the countries they had entered with contracts. And in this is the evolution of the debt of these countries. In blue is the part that corresponds to the ESM. In orange, the part that corresponds to the IMF. And you can see that they're increasingly more important. In the case of Greece, they have more than 1/3 of their debt. But in particular of interest is that, for example, if you look at Portugal and Ireland, the presence of the ESM has helped the market rates to go down, the spreads to go down substantially. So it's this effect. It's not only what you do, but the effect that what you do has in the markets. That's what I was talking before about having a fund of that form. And in particular, if you look at they compare the terms that they had with the IMF and the terms that they had with the ESM terms were much better, both in length and in the interest rates being charged. But that's exactly what suggests the issue I said before. You see here, as in the case of Greece, having more than 1/3 and more than 30 years. So they have transformed the Greek debt into very long-term debt. That has helped a lot. Because now we are not seeing in the newspaper what will happen next month that they have to roll over the debt. That will happen many years down the road. But what will happen many years down the road? We will be older. So that doesn't seem to be a very good design. It's a huge improvement, but we can do better. On the other hand, you look at the case of Spain, that they had not for so long. Spain has been growing, and Spain had to ask permission to start paying faster. They got the permission. But an optimal contract, the one that I described, is not giving you permission. It tells you that's what you're supposed to be doing. If now the economy is going better, you should be paying more. And to which we should say, look, we're not going to wait 30 years. If things start getting better, you pay more. Because we also want to know that you should know that if things go worse eventually, you might also get more help. So that's the different idea. So it's just to having fun with these principles. So we have an all carrot, because contract is always sticks and carrots. The property of being in the union is that the sticks are limited, and they should be limited. And we designed that. So we had this carrot. I've done the job. So now we propose a new carrot, the ESF. Thank you.
So while welcoming the arrival of President Roberto Gualtieri, as well as President Mario, I give the floor to Marco Buti.
Okay, thank you very much for the invitation. I would like to go back to basics on these matters, because it is clear that the discussion in the Eurogroup, the discussion the Euro Area Summit show that member states are on radically different positions, and they are in different places. So I think it's very important to make the case from scratch, so it is not only at this stage, unfortunately, The how, and I think it is here the report does a very good job in highlighting a number of features on how we could construct certain elements, and I think also showing that you can have not a zero-sum game, but a positive game where everybody gains. But I think we have to address still, I would say myself, unfortunately, but it is the political case, the if and the what, not only the how. Now, I think if you look at the debate, and I refer to the arguments that are put forward in the Eurogroup regularly on, on a monthly basis, you have essentially two objections to create a stabilization function of this, of some sort. One is that we do not need it because, I mean, it is enough to, that you create sufficient buffers. Go to the MTO, medium-term objectives. You have a broadly balanced budget. Then you have plenty of space to absorb the shock. So you don't need anything at the central level because you can do it by yourself, having created the buffer in the first place. Second argument, which is slightly more sophisticated, is that look at the US. The US actually has pretty little public risk sharing, so done via the federal budget. A lot is done, and the large majority, and I think and our studies also confirmed that, economic literature is pretty unanimous on this, a lot is done via the markets. So it's private risk sharing. This is portfolio diversification, it is capital movements, and so on and so forth. So basically you don't need that on the public side because you have the risk sharing done at the private level. So these are the two basic arguments. Okay, how do we respond to these two arguments? And I think it's important to get the first order, not the second, not only the second or the third order arguments, right? Okay, the first one is that, first of all, it is true that it is absolutely essential to create the and recreate the fiscal buffers then especially in good times. And I mean, the Commission has insisted a lot that countries, especially those with high fiscal imbalances, high public debt, seize the opportunity to recreate the buffer. So clearly going towards the MTO, achieving the MTOs would give quite a bit of room for maneuver. However, if one looks at the experience of the crisis, and here we are talking about large shocks, you have collapse of revenues of 6-7 percentage points of GDP. If you take the example of Spain, a case like Ireland, so the 2 to 3 percentage points of buffer that you have and are absolutely essential in order to let the automatic stabilizers play are not enough in the case of very large shocks. So in those cases there, having something which actually supplements what one can and should do at the national level is paramount. So we clearly see a sequencing here in which you get hit by a shock, you let first the automatic stabilizers work, you supplement that, provided you have the fiscal space, with the discretionary policy, and then only on top of these first two lines of response, you have the fiscal stabilization at the central level actually operating. So this is, I think, the first point, which I think is important. The second point is the argument of the US and the private risk sharing. Okay, the first element here, which is somewhat to be noticed, is that those countries which make this argument here on the private risk sharing are also the countries actually which are skeptical on completing banking union and capital markets union. And in the US, you have that private risk sharing precisely because they have a banking union and they have created that. So there is a bit of an argument here which you cannot cut two ways. Second point, which I think is is particularly important is that the argument of the importance and the prevalence of private risk sharing works in normal times and in normal cyclical fluctuations. That is true that in those circumstances, the normal cyclical the upturns, the downturns that you have, there is a lot of smoothing away, provided that the financial markets work properly, via the private portfolio reallocation. But the experience, again, that we have had is that this actually, this channel of private risk sharing breaks down under very, very large shocks. Under very large shocks, actually, you see the financial markets, they work procyclically, and they actually accentuate the role of the, accentuate the effect of the initial shock. They do not work counter-cyclically. So it is true that there is you have this importance of the private risk sharing, but this is key in, let's say, in normal cyclical fluctuations, not in the case of very large shocks, where it is essential that you have the public supplement, which is the fiscal stabilization at the euro area level. Now, what is behind politically these objections is an overarching arrière-pensée. And it is that the fiscal stabilization at the euro area or union level is put in the bucket of the public risk sharing side. And since there is some sort of a skin aversion to this type of public risk sharing, then there is there is a natural push back to that. But I think this is a misreading of what fiscal stabilization really is. It is true there is an element of public risk sharing there, but there is a lot of risk reduction as well. Take the if you reduce the impact of a country-specific shock, this also helps actually to keep the financial markets more, on a safe place, and this actually favors the risk, the private risk sharing I talked about before. I mean, if you reduce the likelihood that the shock to the real economy infects the financial markets and the banks, actually this reduces the risks that you have in the system. I think reducing the likelihood of pushing a country to the ESM is also an element of risk risk reduction. What we have seen is that when we had in the crisis, either in the entry phase or in the exit phase of EU IMF programs, the problems were not only for the countries who had to apply and be, let's say, on the receiving end of the funds. It was a drama politically also for the creditor countries, because one had to go through their parliament and having to accept, to vote an adjustment program of that sort, so which actually was not a particularly easy exercise. So I think this has to be taken into account, and there are other channels also one can discuss. I'm not going to spend time on this, showing that actually having a fiscal stabilization at the central level is important, not only for, let's say, on the risk-sharing side, but also on the risk reduction side. Clearly, in order to do that, one has to have a proper design of this, and there are some proposals, a number of proposals in the ADEMU report, both on the unemployment insurance and on the fund. One clearly has to get it right in terms of eligibility. So here you have to foster the good behavior in good times, so to make sure that the buffers I have indicated are actually created, that you do not discourage the structural reforms, actually you foster structural reforms. So the eligibility is important. In terms of activation of the stabilization itself, I think it should be as automatic as possible in order to reduce the acrimony of discretionary decisions when this is activated, when the conditions are applied. And third point is in terms of the destination of the funds, I think they should be for, let's say, good spending and not wasted. I think if you have a system like the one we outlined in our proposals in our package of December, then that would be essentially for protecting public investment. So that would be, in a sense, help not only on the demand side of the economy, but also on the supply side by building up the productive capital of the economy. So maybe I stop here. I had a few slides, but they can be distributed to the colleagues who would like to see them. My main point here in this is that we have to continue to make the case going back to basics and going to the fundamentals, because the political debate from here till June will still have to address these basic issues which remain contentious between countries. Thanks.
Thank you very much. Presidente, lei...
Thank you. I would like to thank European University Institute, congratulate for this project that produced very relevant bulk of materials and researches. I tried to went through also the various papers that are included in this project, and there are a lot really. I read some of them, and I found really a lot of elements that support the view that was also presented by in the first intervention as a overall assessment on the two elements, the unemployment, European Unemployment Insurance System and the European Stability Fund, which I agree is a better name than European Monetary Fund, more related to the real task. But as I said this morning, we have in Belgium we have a derogation from the law that normally nomina sunt consequentia rerum, because we are in the Magritte city, so we can also use names that do not reflect things. So at the end, the name is not the most important thing. But going back to the two presentations, I also agree with Marco that in this current very, very challenging and difficult political context, we really need first to start to make strongly the case on the if and the what, and then identify the possible solution on the how, where of course you have intermediate steps that clearly might not be optimal, but you have to have clear in which direction we are going in order to go on a dead road that led us nowhere. So I have to say I have a very similar, let's say, structure of my intervention of the one of Marco, and the first thing is I think we should look at is history. So what happened, because facts are so clear and so evident in showing us that the original idea that you can sustain this asymmetry between monetary economic policy, giving the task of addressing symmetric shock to monetary policy, and giving to national fiscal buffer the role of addressing asymmetric shocks, plus having no bailout clause, which in time of of normal times, nobody cares, and so you have financial integration with risk-taking and exaggerated. And then in the moment of crisis, especially if you go to Deauville and say what they said, create on the opposite, also the credit risk, redenomination risk, what is also some of the contribution I read, the expectation and so on, and then the liquidity. There was a very good paper on that, on what happened also on the margins, on the repos market. So all this, the two things combined, create what happened in the crisis. So we had, as Marco said, this drop in production and employment that no fiscal buffer could have addressed. And then you have also, I would like to stress also this element, the combination of the two shortcomings, so the lack of macroeconomic stabilization function on the one hand, and also the insufficient definition of the crisis management on the other hand. And so the vicious circles that took place is the one with the first crisis, the slump, then we had this first answer of a coordinated fiscal stimulus, but then we had the second one, where also the political component interfered. So we had the sequence with exactly Deauville, the crisis and sovereign markets, and then the trade-off between limited and too late intervention with the ASM, but then the political conditionality of very strong procyclical fiscal policies, and then what happened with the recession, and so all the combination of two elements clearly show that we lack these two components, macroeconomic stabilization function and a more credible risk management function. And then also in the aftermath of the crisis, the effect of this incompleteness of our construction was the stretching to the limit. This is another paradox, like the one that Marco stressed about the private risk sharing. The other paradox is that at the end, the consequence of not having these two tools is that we had to do, because it was unavoidable, exactly the things that those who are against these things want to avoid: overstretching monetary policy and overstretching fiscal rules, because it's unavoidable. If you don't have other tools, you have to push a lot on monetary policy, as we did, and also you have to, at the end, to make more flexible and adapt your fiscal framework, because these are the only tools that you have. So I think that the historical evidence makes, and not only the abstract definition, optimal economic and monetary union, makes very strong the case of moving toward an improvement of the crisis management function on the one hand, and on the other hand, the building up, because we don't have at all this, unless we can call it a globalization adjustment fund. That was if one who wants to find an atomic embryo, we can find somewhere, but of course is not what we are talking about. So we go back to exactly this strong case, and I mean, what we welcome, of course, on the Parliament side, that finally the Commission has said that we need to do that, and has somehow prepared the ground to move in this direction. With the solution which, let's now first talk about the macroeconomic stabilization function, is, my view, far from optimal, in the sense that I see the logic of saying at the end, investment protection is not so different from unemployment benefit, because is the same. You see the same thing from two sides, but is not totally true, because in my view, as also in your contribution, you try to demonstrate. That unemployment, you call unemployment insurance system, unemployment benefit scheme, or whatever the name, is, I think, more efficient and easier also to have to have this characteristic of automaticity that also Marco said are one of the main criteria you should have. I think it's a bit more difficult with investment protection, and also this element of the loans. I understand actually the Commission is tomorrow. This morning we had Moscovici and Dombrovskis in our committee. They referred to also a grant component, and I think this is also very important, because building up, one thing is to say in the long term, in the medium term, we think that this goes in equilibrium, and we are not talking about the transfer union. Another thing is defining the investment protection as a loan, as really a loan. So I think the two things are similar, but are not, again, and not the same. So if you say investment protection and loans is something which is a bit less than what I think define a mechanism which is balanced in the medium term, but and is based on unemployment benefit, which should address exactly the cyclical unemployment. We know more or less, and also, I mean, the paper was very convincing. We had other proposals which go in details, even going about the size, how it would work, projecting the effect in a number of years. So at the end, it's something that could have a cost-benefit dimension, which at the end is absolutely manageable in my view. Is not so big comparison with the advantages. But okay, we understand that now the Commission is moving on this other idea, and one wants to be politically realist, is one has to at least expect that this idea is substantial and not just a hint to a future. Now we are in a critical crossroad, because this has a very strong link with the resources we have, with the multi-annual financial framework, and with the way in which we are able to say that one thing is the general budget, one other thing is provide a specific macroeconomic stabilization function, which is mainly, maybe one could say not necessarily only, but basically specifically addressed to the euro area, because is strongly connected to the fact that we share a currency, that we have a single monetary policy, and so we don't have the normal adjustment function that the exchange rate can provide. So this is essential. And then we arrive to the issue of resources, of course, because to make it serious is a matter of how it's defined, how is organized, which are the eligibility criteria, the mechanism, the governance, but of course there is also the element of the dimensions of what we are talking about. And here I see the connection with the discussion and debate on the other function, which is the crisis management function, in terms of the institutional dimension, the institutional shape of this, because we very much welcome the Commission, I would say, courage and determination in propose the integration of the ESM into the EU legal framework via Article 352. We are a bit, astonished in the way in which the Eurogroup is saying, okay, we first discuss the content, and then at the end we see whether or not it will be integrated, because this is not a separated element and unessential things that could be left at the end. It has a very strong implication, not only on how the new ESM or ESF or monetary EMF would work, but also on how we could also make use of this very strong buffers of paid risk capital and borrowing capacity, also to give more credibility of the macroeconomic stabilization function, because in my view, and also as it was hinted in the Commission documents or package of December, I think that an ESM integrated into the EU legal framework could be more easily a backstop. Mr. Regling spoke about a facility of a stabilization function, giving credibility exactly because we are talking about something that is activated only during specific cycles and is not logic to keep in reserve in the budget a high amount of money, not to freezing it because of this. So the combination of a small heading or budget line supported by lending capacity, backstop capacity by the ESM, integrating the legal framework makes more sense, and I think is not just an element of institutional elegance that is essential, that is enters into the area of the EU law. This function. So it's not just for, let me say, democratic accountability reasons that are also important, even if, as I always say, I repeat also here, because everybody has this. And we want to be crystal clear. We don't want this because then we want to play the game of having the full control on this body, because we are aware that as far as it is financed by member state money, we understand the reason that should have a kind of a greater autonomy respect to other bodies which are financed through the EU budget. So it makes logic that the Parliament is not necessarily to appoint the managing director, the head. So we have the example of the EIB, which is an independent institution, which has some element of accountability toward the Parliament, but it's not the Parliament who appoints the management of the board of the EIB, exactly because the money are member state money. So this is not. Nobody should use this as an excuse not to go in the line of Article 352, integration on a union law. Then there is another element which is essential, and we move to the crisis management function, which is how, because I totally agree that we should make the switch, and what actually is the idea of a conditional support already, as you correctly said, from unconditional risky to safe conditional. So that's exactly what already is imperfect, insufficient, with the need to involve IMF, with not enough instruments to use in its toolbox. So what is already the ESM? The very point is how you define the conditionality, and what are the conditionality, and how you make this conditionality a positive element, and not something which ex ante creates, let's say, self-fulfilling instability elements. And so here is essential what is the difference is between what is about the possibility of restructuring of debt, the difference between a mechanism and the framework. And also on the framework, one has to be very prudent, of course, because when I hear about the framework, I want also to see exactly what is this framework. But a mechanism is totally counterproductive, and positively is so far out of the table, because my view would have exactly the opposite impact, effect of creating the self-fulfilling dimension of this credit risk, predomination risk, which would, in the form of higher spread, make more likely and not more unlikely to have a sovereign crisis. On the other hand, of course, one has to have a clear framework to provide, to make use of the option, which is already one of the options. It's not automatic option, but is already an option of a restructuring when needed. So on this, we need to move absolutely with great care, and we will be, of course, also very vigilant in this sense. Then there is the point, very important, that also was made, that we are the first to recognize that we need to complement the public risk sharing with the private one. So that's the reason we strongly support capital market union, completion of banking union, and I also know the contradiction of those who insist on the private risk sharing instead of the public, but then are against those necessary decision and which would make more likely and easier to trigger this private risk sharing. Of course, in this area, one has to be realistic, because one thing is to talk about in abstract of what in ideal term would be a fully integrated capital market banking union. One other thing is to recognize not only the political constraint that we have, and unfortunately we have, and we try to overcome them and to have the EDIS, to give more power to ESMA and so on. But one other thing is to recognize that to have a US style, let's say, full integration of capital markets, it's in any case, even if the most ambitious things proposed by the Commission will be accepted by the Council and the ESA review, everything which is in the table, this is not something that out of the blue will create this perfect integration of financial integration of capital markets. So it's a process that has a lot of steps to be taken, also in terms of harmonization of national legal framework and going toward a true full-fledged single supervision. So we have a lot to do, and this is an additional reason why we cannot wait and just say, because we write in some paper that we are doing something which is in the framework of capital market union, and we say, okay, this is done, this is done, this is done. We did the prospectus, we did the STS, but this is, I mean, it's very important steps, but there is a lot of time before this will transform in a fully integrated financial market. So again, also, going back to the basics, this clearly shows the need for having the courage and the political determination to make the necessary step. So we are in a very critical juncture, also for political reason. I mean, the country I know best now is a question mark. What will be the position of my country in this discussion? What will be the government? What will be, and this is of course an element which create a great uncertainty, because Italy has always been decisive and pushing from one side of creating a balanced element of rights and obligation in order to enhance our governance, to have a more stronger budget, to do all the things which are necessary. So I, of course, hope that Italy will continue to be in the right side of this battle, but we don't have any guarantee about that. So on this we have to be. So this gives even more responsibility to the European institutions, to the European Parliament, to the Commission, to try to be to stay with strong determination in this battle, and gives a lot more of responsibility also to those member states who have clearly said that they want to move in this direction, but they to be aware of the need to provide a balanced combination of elements where at least not, if not everybody, but at least a majority of member states could feel at home and not going under, let's say, in an era where we're going to lose any control of the future. So it is a matter of creating, and that's why any agreement done at two will always create this sense of exclusion. So it's extremely important and challenging, also taking into account the political situation of some member states, that we create a constellation, political constellation in the Parliament and in the Council with the help of the Commission, which create a broad basis of consensus, at least of some essential element that we have to start putting into place. Then if we have to phase in, if you have to give us more time, let's do that. But let's clearly set a clear way forward, which is based on a platform which is a platform where if you are north, south, east, west, you feel that you are part of this. So I think this is essential, let's say, politically, a part of the very relevant technical elements that we have already described. And that's the reason also why, and I'm sorry for being so long, I conclude, the role of the Parliament is essential, even if it's unfortunately for many of this dossier is not fully decision-making role, to be the place where we can show that we can create and build the bridges and the compromises toward this stronger framework. So we have ahead of us crucial weeks and crucial months, and we hope that also thanks to the contribution of your reflection, of your work, we will be able to give answers that are now needed. Thank you.
So, as always, when the debate is very interesting and touching a delicate question, as the final words of President Gualtieri reminds us, we have been a little bit too long. So there is still time for a couple of questions if I see two. There is a microphone in there.
Thank you. I'm just interested, since you all raised many of the key issues here, like it's the normal adjustment of an exchange rate is not possible, and the large negative shocks that can reach 6 to 7% of GDP, and yet these can be productivity shocks, not just cyclical. I mean, it's convenient to expect them to be cyclical, but politically often, but very often they're structural. They concern key industries, export industries, and the small countries particularly are in trouble when their productivity collapses. And since in the euro you can't use the exchange rate mechanism, and there was very limited nowadays in Europe what you can do. So most often the answer has been wage declines. And since the trade unions are very strong in Europe, they resist these wage declines. So they reached through unemployment. In practice, people have to move to lower paying jobs through unemployment. And if you establish such an unemployment insurance mechanism, you're actually allowing them to stay in high unemployment areas and not move in search of employment. So this may actually lengthen the unemployment duration and hence also burden increase the collective burden on public finances in Europe. As a result, even if you share it across, I mean, collectively it's increased, if the unemployment duration increases due to long-term unemployed being gradually, they moved from the labor supply in practice. This is what happens. So how do you see this as a solution to the basic issue? The problem with the EMU is that you don't have anything that solves the productivity problem and the unemployment issue related to it.
Okay. Let's take a second question, more direct if possible.
Yes, short question to Ramon. I'm Paolo Pasimeni, European Commission. If I well understood your model of an unemployment insurance scheme on the revenue side is based on a tax on wage. And I would like to suggest a possible alternative, I don't know if it's possible in your model, based on the analysis of the US federal budget that we are doing. I mean, together with a colleague, I've measured the stabilization capacity of each item of the US federal budget, on the revenue side and the expenditure side. On the expenditure side, of course, social security benefits are is the item which provides the best, let's say, stabilization capacity in terms of interstate risk sharing. On the revenue side, what we find is that the most important item, the one with the largest stabilization capacity in the US federal budget, is corporate income tax. And this is also conceptually, logic in a sense, because the two items help in a single instrument, help bridging the gap between the mobility of capital, which is higher, and the mobility of labor, which is lower, of course. So I don't know if it's possible in your model to include a different source of revenue rather than tax on wage, tax on corporate income.
Okay, maybe I take the first one very quickly. No, I think you make a good point, and always when one has to think what is the optimal response to a shock, one has to assess the persistency of the shock. So what supply side shocks of the productivity type or that you mentioned, they are usually more persistent than the let's say demand side shock. And in those cases, you instead of needing pure stabilization, you actually need the adjustment of the economy. At the same time, I think what you have in this case of these productivity shocks, you have a large impact. Take a country you probably know well, where you had the collapse in a certain sector, which actually lead to high high unemployment, a surge in unemployment. And what you would have via this stabilization fund, if you take a system with unemployment insurance, you would have to, you sustain the income of, to a certain extent, because the replacement rate, as Ramon indicated, is in any case reasonably low. So you are not going to fall into an unemployment trap here because of these incentives. So you sustain income, and that should be coupled, and this is an issue that one has to look at in terms of the design of the system, with retraining opportunities in order to help to move from one sector to another sector. As part of the Commission proposals that we have outlined in December and will be formalized in May, there is a reform delivery tool which has precisely that type of meaning. So I mean, you will have something provide incentive for structural reforms, which we know are, in many cases, take labor market reforms, politically costly, in certain cases also economically costly in the short term, and foster the reforms which would allow to tackle the kind of shocks of productivity type which are more persistent over time. So one has to see here a package of reforms, so the fiscal capacity, which has a stabilization element, but has also a reform delivery support, which would help to do the type of reforms that are needed in these cases.
Yeah. Thanks. I think that our job as a social scientist is to something that it was in the call that we applied, which was to generate new ideas and new possibilities, and also to provide a framework. And that's, I think, what we had been working. So it's not our job to make a decision. That's maybe in other parts of my life I would have been in that situation. That's not on what to do one thing or another. But yes, to be able to screen different possibilities and see what to expect to work or not, given our experience, given what we can do, which is these counterfactuals that happens many times in the computer. So yes, it can be other sources of revenues, but we have been very careful not to go to other sources of revenues which were way far from what we were discussing. Okay, we just put our discipline here. It's possible, certainly. But I mean, that's part of the exercise to say, let's have something which is online of what they're doing and see if these countries which are so different can agree. And because the answer is yes, if we do it the particular way. And I think that in general, that's what we had tried to do, and I think it's a good exercise, is keep things very much in balance in terms that, as I said, be very respectful, that we don't want to intervene to have to tell people what to do. We just have a framework that countries and people react and in a way that it will go in their own interest, in a way that it will be in a common interest too. And that's what we have been thinking on all the proposals. And I thank a lot for the participation in this.
Well, I just that I find very, logic the idea of the corporate there is also in the Commission now the idea, and we support it, to use also this digital taxation. This is not exactly the same of some as a basis of own resources, so that it makes sense. Also depends, because if it's more an insurance unemployment, it is also is logical, so that how it's defined in the proposal. So I think it's also depending of is it more an insurance-based mechanism or a more basis fiscal capacity which provides this function. That's high view, but it's clearly is an interesting suggestion.
Well, given the hour and thanking you again, I propose to continue the conversation over a drink. Thanks a lot.